It's a strange new world in which we find ourselves where commodities in the mining sector are regularly leading the Bloomberg broadcasts and find themselves on the front pages of the broadsheets. It's unfamiliar territory and speaks to the urgency that has been created around critical minerals and supply chains. It's an eerily similar scenario for the data center universe, a brand of infrastructure that emerged in its first form in the 1960s and has long been obscure and consigned to the technology trade press. Data centers are today sexy and spoken about endlessly by politicians and the breathless mainstream media. Now those two sectors, copper mining and data centers, are converging or potentially colliding. For natives to the raw material space and copper specifically, the challenge is clear. By some measures, the industry needs to find, permit, build, then mine 17 Escondidas, the world's largest copper mine, to meet 2035 consumption expectations. And this is at a time when grades are declining, and so the holes that need to release the same metal need to be larger, and society's appetite for environmentally intrusive industry is at an all-time low. On the demand side, copper miners have taken to using sensational numbers associated with AI and data center build-outs to stir up investors. An apparent 37% increase in data center capacity, or another 2,260 facilities by 2030, makes a great slide in a presentation or a pithy line for the trade press, as did the stream of announcements from the hyperscalers who are dedicating eye-watering capex towards undefined AI and data processing growth. But the fact is, the mining sector knows little about the reality of the data center world or its real need for copper. Equally, downstream industry has made baseless assumptions on the availability of copper for its big dreams, with next to no understanding of the production bottlenecks. Is the apparent supply shortage a genuine problem, or simply a lack of awareness? To connect the upstream with the downstream and answer that question, Harbour recruited a leading CEO from the copper space, a data center analyst, and a technology-cum-mining journalist with more than 30 years' experience to unravel the complexities associated with delivering copper into the data center world.
When you get into the meetings, it becomes very clear very quickly that there is a fundamental lack of understanding of just how complicated the mining industry is.
We learned that the problem, as dramatic as it was assumed, is actually greater than we realized. Data center capacity in the US alone is set to reach 100 gigawatts by 2030, which will require around the same number of data centers that the US has built in the past 70 years to be delivered in full. And that is still likely to run short of requirements. The data centers being constructed in the next decade will need to increase their capacity per rack from 7 kilowatts to 300 kilowatts to cope with AI processing requirements. This means 80 kilograms of copper per square meter. And the process to build and refurbish data centers with copper looks like an ongoing recycling and restocking effort, with facilities facing a nominal 20-year life, but realistically requiring adjustments or complete overhauls well ahead of time as new technologies are introduced.
This was the tip of the iceberg in a wide-ranging conversation that should shock mining, data center, and investor communities.
Testing.
Hello, my name's Chris Can from Harbour Insight, and welcome to this panel on copper and its association with data centres. From a raw materials or copper perspective, there's a lot of talk, a lot of big numbers being thrown around about data centres and what they'll mean for future demand, but not a lot understood about the insight of that data centre world. I think from a downstream or data centre community perspective, there's probably even less known about raw materials and the supply issues that could be coming. Joining the dots with us today will be Martin Veitch, a freelance technology analyst and journalist of more than 30 years. Hayden Locke, Chief Executive of Maramaka Copper, and Max Smolax from the Uptime Institute. Max, I'm going to start with you, if that's okay. I wanted to just set the scene by understanding, firstly, when we talk about data centres, we're hearing, as I said, those big numbers, double the capacity coming online by 2030, but those numbers vary. What does it actually look like from the practicalities from a data centre perspective of where we've come from and where we are, and potentially that 2030 story, where do we aim to be?
Absolutely. Well, data center industry has always been growing, and the growth rate has always been accelerated. But I think in 2022, at the end of 2022, we hit a new development stage, and it's all bets are off. So I will just illustrate it with some numbers. So like the entire US data center market has about 50 gigawatts of capacity in total. And if we look at American utilities and how much capacity they have to build under contract for data center developers in the next few years, it's over 100 gigawatts. So like, not all of these data centers are going to be built, but even a fraction of those are going to be built. Even if half of those data centers are going to be built, it's going to double the size of the American data center market. And data centers provide three things. They provide space, power, and cooling. And power and cooling are depending on copper and on copper prices, and the demand is only going to increase as data center build out continues.
Max, when you say up until 2022, there was 50, so it was 50 gigawatts, is that right? So, and you're saying in the next approximately, yes. And in the next 5 years, or sorry, 4 years or so now we're talking about, it's looking to double. Over what period was that 50 gigawatt capacity established? Was that established over 5, 10, 20 years, or was that over equally short time span?
It's the entire history of computing. It's since we started building data centers in the 60s, but like the Americans only managed to build 50 gigawatts of capacity, and now we're set to double that, and it's probably going to take a little bit longer than 2030, you know, like because power generation assets take such a long time to build, but it underscores the demand. The demand is there, and you hear about it every day, you know, like we're hearing about, you know, new Stargates being announced, and it's not just in the US, right? There's a lot of construction happening in Middle East. There's a lot of construction happening in Asia. China is building out its data center assets as well. And we've never seen anything like this. This is unprecedented. Like everybody in the industry is in a state of shock pretty much every day. So we need help, and we need help, you know, like from everyone.
Where does the power come from?
At the moment, again, before we started building data centers for AI, everybody was a big fan of sustainability, right? Everybody was a big fan of renewables. We were building out renewable capacity, but we cannot build enough renewable capacity to service AI. So at the moment, where does the power come from? It's natural gas.
And from the electricity grid. It's not standalone power generation for a data center.
It depends, but basically more and more we see on-site generation. On-site generation wasn't traditionally the preferred way to it's not a very economical choice to power a data center, but because such amounts of power, they just don't exist anywhere in the world, we see more and more on-site generation. So in addition to those probably 100 gigawatts that are being built by utilities, data center operators are also building their own power, and that's, you know, it's very hard to account for the amount of power that they're building, but again, it's going to be, you know, like tens if not hundreds of gigawatts.
Max, you said that data centers have been being built since the 60s and obviously progressively through that time. What does a data center look like today, or the ones that are being planned for the next 3 or 4 years? What does that data center look like compared to one, say, that was being built in the early 2000s?
Very, very good question. So they're essentially, we see the emergence of two data center industries. On your traditional IT side, enterprise, colocation, cloud, you know, average rack densities, that's how much power a rack of equipment, 42 rack unit, one single kind of stand of equipment, how much it consumes. Averages are about 6-7 kilowatts per rack. If we're building for AI, we're building 130 kilowatts per rack today, and probably reaching 300 by the end of this year. 300 kilowatts, from 6 to 7 kilowatts to 300. And densification requires, again, it requires adjustments on the power side, on the cooling side, and all of those adjustments, they are based on copper. So from the cooling side, it's liquid cooling. So every single cold plate is made out of copper. The more elements within the server you want to cover with liquid cooling, the more copper you need. And on the power side, it's copper in the power distribution, and we're talking, okay, well, I'm not going to go into the numbers here, but we're talking hundreds of kilos of copper hanging over every rack.
Mm.
So I'm going to, pardon me for using a mining analogy here because it's what I know better, but if you look at the history of the mining industry, it pretty much looks the same. There's a lot of cool stuff coming in around automation and digitization, but pretty much it's still digging big holes. It sounds like from what you're saying that if it's a completely different piece of infrastructure than you would have been building 20 years ago.
Absolutely, yes. And it's a completely piece of infrastructure than you would build 5 years ago. So, like all the designs, all the equipment is net new. Approaches to power, approaches to cooling, all of this stuff was essentially adopted from supercomputing and redeveloped over the past 3-4 years.
Okay, and just assuming that we've got a diverse audience that are watching this, Hayden, would you mind giving us that same kind of top level background on what raw materials, essentially that extraction, but particularly copper, what the copper supply piece looks like, what copper is used for, and what the state of play is at the moment for projections for the ability to supply out to 2030?
Copper is primarily used for anything to do with electrical conductivity. There are some other minor portions of the industry, but overarchingly, it is fundamental for conducting electricity. And I think the reason that we became interested in as a company and invested in this project that we have in Chile in South America is because of that impending demand shift that we saw coming. Now, mining is an incredibly cyclical industry, and that is fundamentally driven by the amount of capital costs required to bring these mines into production and the need for a sustained and higher level of commodity price to incentivise the capital to come into the business.
Can you give us a feel for what kind of numbers that we're talking about? Maybe a bit of Marimaca, obviously you're looking at that at the moment, but broadly some of what we would consider those tier one large scale, which hopefully you'll be building at some point at Papa Medina. But
Marimaca is an outlier, and it's a very, very small project from an absolute capital cost and capital intensity perspective, and it's still over $600 million once we get all of the bits said and done. The average, I remember sitting in a room of new copper developers. These are projects that are in the pipeline supposedly to be built, and the average capital cost was $3 billion. The average. And they are only going to go up. They're often in very challenging jurisdictions. I think we see the announcement of the Vicuña district at the top of the Andes. Pretty competitive capital intensity. I think it was $30,000 a tonne for each tonne of new copper. Now that's going to be a 100+ year mine, so it's fantastic that it'll eventually become a producer. But I think when you look at their economics, they need a higher copper price to really incentivise investors to come and take that risk.
What kind of lead time? That's a hugely important prospect that I think downstream really don't have a handle on.
Yeah, one of the points that I've made several times when I've presented the thesis for copper is that actually supply is the biggest risk. The demand drive has always been there. It's fundamental to the way we live to have copper in our lives, and it's only becoming more important as we go through. And I don't think people appreciate how much they use data centres already on a day-to-day basis. Everyone is connected to these things. If we want that to continue, we need to have more copper. But the challenge has always been that it takes a long time to discover new projects. Once you discover it, you then have to spend several years drilling it out and understanding it from a geological risk perspective, a metallurgical risk. Then you overlay the new paradigm, which is permitting risk, and the fact that some jurisdictions, people really don't want mining in their backyards because it is an invasive industry, and it's a large and hasn't had the best track record of marketing itself well. The stats are pretty scary in that new mining projects are well over 20 years from discovery to first production on average. And so what we have is incredibly inelastic supply and incredibly inelastic supply response to meet this sudden an incredible surge in demand. I mean, I was referencing some of the announcements out of the hyperscalers talking about $650 billion of capex on AI and data center build out. That's all of their cash flow for 2026, and that's what they're predicting they're going to spend. I mean, where are the raw materials going to come from? It's just not feasible.
Really obvious what's emerging here is obviously from Max's perspective around data centers, or that insight into data centers, a huge need and expectation that those raw materials are going to be there. And obviously Hayden painting a great picture for us around the fact that even if you want to deliver all that supply and you push the button, if it was available today in those new projects, you probably still potentially, and hopefully there's some accelerating processes in play, but you're probably still 10 or 15 years away from delivering it. Martin, from your perspective, obviously you've spent a lot of your career analysing and writing and speaking to people in the technology space, probably more in Max's world, but in the past 5 to 7 years you've been working more in the mining tech space as well. How would you describe the connect, or probably more accurately the disconnect between the conversation upstream and downstream?
Yeah, disconnect's the word, Chris, and kudos to your people and Marimaka too for joining the dots here, because speaking to Max earlier, these are worlds apart and the worlds are colliding, and you're doing a good job in just getting that debate going, because traditionally, as Max has outlined, data centers are going just through a phenomenal multi-decade boom. We've got so many drivers. Cloud, crypto mining, audio, video, what we're doing today, all these massively compute intensive type applications. And now with AI, we can just multiply that. It's just a phenomenally bit hungry technology. So there's a massive demand for data centers. The gating factors typically on data center build out, well, cost obviously, but also number one, probably power access, arguably, and then regulations, I would say. So the demand is there. Every time we send an email, every time we access the internet, pretty much every hour of the day, we're all using these data centers, whether we know it or not. And, the raw material and the mineral aspect of that has hardly been explored at all. But copper could well be a gating factor going forward. Everything we know about what's happening with data center demand and what's happening with the necessary ingredients for that suggests that's the case. Just a couple of numbers. I know we've been number heavy already, but they really are phenomenal. At the moment, data centers account for about maximum 3% of the world's electricity consumption, so small but significant, somewhere along the lines of the airline sector perhaps. Maybe going to be 12% by 2030 to 2035. 13%, 12% if you believe McKinsey. So the growth is only going one way, and that's going to put incredible onus on the data center build-out people to be able to say, have we got all of our bits in place to be able to put these things together? And copper is going to be a big aspect for that.
So presumably you are talking to these groups about putting these bits and pieces together, Martin. When you ask them about the upstream raw material supply chain factors, do they have any understanding of what is happening in that part of the world?
Well, I'm sure if you go to the realtors, the people who are doing the building block stuff, that would be the case. I don't think if you talk to the marketers and some of the C-level executives of some of the data center companies, that's going to be front of mind at all. When we were talking about this session, you were getting some blank looks when we were trying to ask people about this stuff, frankly. But everyone talks about EVs. Everyone's been obsessing about that. Everyone knows that the smartphones and the computers we're all using every day depend on rare minerals, and we all know how copper is as a core component. But no, I think it's a bit of a sleeping threat, and I think the data center sector has to wake up to it in the same way that any organization would that is going to be potentially missing a key component of their value chain.
Max, we've touched on it already, what's required to build a modern data center, and as you said, that design is evolving over the next few years as well. Can you give us a layman's breakdown of what is required, the infrastructure, what are the pieces and components, the main pieces of kit that are required to build a modern data center, and where some of the restrictions are around getting that done?
Of course, yes. So let's imagine a data center row of 20 racks. Let's say they're 40 kilowatts per rack, which is, it's higher than average, but it's lower than many of the AI training deployments out there. You need about 40 kilograms of copper per meter. And if you want the system to be resilient, you need diverse power distribution paths, you need to double it. So we're talking about 80 kilos of copper per meter just to support that row of racks. And it's becoming silly very quickly, and your only alternative pretty much is to use aluminium. Aluminium is less heavy, but it takes more space and doesn't really like thermal stress. So if your data center, you know, if the temperature is going up and down, it can actually develop faults. So that just leaves us with copper, and the problem that there's too much copper to actually hang up on the ceiling. You know, like people are looking at their ceilings and they're thinking like, can I actually build a data center here? Is it gonna survive the tons of copper that are gonna be hanging from the ceiling? And then there's liquid cooling, of course. Direct-to-chip liquid cooling is emerging as the dominant form of liquid cooling, and direct-to-chip liquid cooling is all about copper cold plates. And the more elements within the server you want to cover, the more copper you need. The only alternative, again, is immersion cooling, right? It doesn't need copper because you submerge the entire server in coolant and your chips are essentially in direct contact with the liquid. But it's not going mainstream. We've been tracking immersion cooling for probably a decade, and it's gonna happen tomorrow. And in 2026, you know, immersion cooling is still not mainstream, and we don't see a path for it to become mainstream. So alternatives are out.
So it's dual aspect, that there's the power being delivered to the racks and then also the cooling, which I thought it was all to do with the cooling rather than the security of supply to the racks themselves.
It's both. You transfer electricity in and you remove that electricity as heat. Every single watt that comes in as electricity escapes as heat. This is what makes copper so invaluable.
Are there any technologies in your view, or any potential disruptions that could occur to that thesis in the short to medium term? You know, I've heard graphene as an example, highly conductive man-made material, but it's been very difficult to manufacture on an industrial scale. But anything else, improvements in chip efficiency that could change that thesis?
There's two potential future developments. One is superconducting bus bars. Once we get superconductors, you know, like a lot of these problems are gonna stop being problems, because you will essentially be able to supply unlimited amount of power down a single piece of wire. They will probably need to be super cooled though. They will and it's basically, it becomes a very, very complicated thing. On the efficiency side, one of the things that could happen is there's a lot of interest in development in neuromorphic computing. Neuromorphic computing is a completely different approach to AI. It's very different from GPUs that we're using today, and it could be much, much more efficient. However, we're essentially starting from zero with neuromorphic. We would need to redevelop every algorithm, every model, every tool to work with neuromorphic, and the chips themselves, they just cannot support the clever stuff that we want them to do. So 5, 7, 10 years down the line, possibly they will make AI more efficient, but at the moment, there's no end in sight. AI systems are going to become denser, they're going to contain more copper, they're going to require more power, and they're going to produce more heat.
Can I ask a really basic question, Max? In terms of what you're describing around a data center, what does it actually look like, the infrastructure? Is it essentially a big warehouse / factory with a whole bunch of racks, with a whole bunch of computers and a whole bunch of wires coming out of them? Is that what it is?
To a point, but essentially, so the rack space, the white space we call it, has been shrinking basically as equipment becomes more and more dense. The actual data center is becoming smaller. What's becoming larger is the supporting equipment, is the batteries, is the generators, is the power distribution, is the cooling equipment. So all of that stuff just occupies more space, and then you have the shrinking data center in the middle.
Okay. Going to the mining side of things again, Hayden, and looking at the supply. And you gave us a great snapshot of, you know, the idea of how long it's going to take to deliver a quantity of copper and some of the bottlenecks. But as we know, there are a lot more challenges that are really pressing. How do you see the prospect of actually delivering anything like the kind of capacity that it sounds like is going to be needed by data centers, given the current state of play in mining?
Prior to this conversation, and thank you very much, Max, for putting the fear of God into me. Prior to this conversation, I would have said there are enough projects in the pipeline that with a correct copper price, there could be a supply response which would allow us, certainly for the foreseeable future, to achieve some of these objectives. But if the wave of demand is coming, as Max suggests, then you know that the AI CapEx announcements that all of the Magnificent Seven have made suggests, then I think there is a real possibility that the copper price is going to move significantly to encourage those projects to move more quickly. I was just at Miami for the annual BMO Metals and Mining Conference, which is one of the major conferences, and it's all of the big companies come together. And the feedback was that certainly on the copper side, on the base metal side, with the copper price at $6 a pound, that people were happy but cautious. And so cautious means they're still not willing to to sign off on the big capex bills to start building these projects. Now, the vast majority of projects in the supply side models for Wood Mackenzie require at least 5 years of development before they produce 1 tonne of copper. Very few of them are sub 3-year build outs. And so even if we started today, we're 3 to 5 years before any incremental tonnes come. And then you've got the risk of these external supply shocks, like what happened at Grasberg, like what's happened at Cobre Panama, which will probably come back online in the near future. But who's not to say that there's some other external shock that causes the supply side to be put under further pressure. So yeah, it's concerning. We're not even in a world of synchronised global economic growth. Imagine if suddenly the world started growing in a synchronised fashion and people started consuming electrical goods.
Yeah, I don't think we're in any danger of that happening anytime soon.
Well, you just never know.
No. Where's the reticence come from with the willingness to put capital into large capex copper projects? That surprises me.
Well, look at Vicuña, which is probably the most significant new and most important new copper discovery, and one of the best copper discoveries of the last, it was made 15, 18 years ago, but certainly one of the best.
Speaks to the cycle.
Yeah, which speaks to the cycle. One of the best new copper projects. They put out a study recently, I think they used nearly $5 a pound copper, and the IRR was sub 15%. For a large scale capital intensive industry with multiple geopolitical risks, they're exposed to Argentina and to Chile in the high Andes. Is that enough to convince them to pull the trigger on it? I mean, they'll continue to chip away at it, but I think that's a fantastic project. Imagine the other projects that at $4.80 are achieving single digit IRRs. Are investors really going to greenlight a CEO and a board to go and spend that money on something that's going to yield 8% without confidence that actually we're underwriting a higher copper price?
And this is the disconnect we see, right? All of the data center folks are ready to go at any time. They can't build fast enough. They're dominated by the world's largest organizations, Microsoft, Alphabet, Meta, Alibaba, Oracle, Tencent, and they just can't spend fast enough. They can't keep up with need. Copper and data centers go together like eggs and bacon fried. They can't live without it currently. And there's no end to the demand that's required of these data centers. Everything we're doing is becoming more and more digital. The old phrase that Mark Andreessen said about software is eating the world 15 years ago. Well, Jensen Huang at NVIDIA said, and AI is eating software now. So, the demand is just through the roof. And unless we ensure that copper is there, we're going to have a big problem. Copper is only about 0.5%, according to my research of the data center build out, a list of ingredients, but you can't live without it.
Speaking about, Hayden, you talked about the amount that's being invested by the hyperscalers as well. Martin, you're touching on that point, and the capital deficit from essentially private markets. We're obviously seeing a lot of critical mineral, if I'm allowed to use my air quotes there, investment into the mining space. The White House is obviously a big push. If the EU kind of gets out of its own way, it may also pick up some speed there. Are we going to see more, or do we need to see more government support, but also see some of that cash from the hyperscalers that's being thrown at tech development? Do they need to start throwing that at raw material supply?
I would say 100% they do, but it is if we talk to generalist investors that we meet, which we're starting to meet more of now that the prices are moving and they're seeing the returns in their portfolio being eroded, they typically will start with, I really hate resources and I just don't want to be here, but I can't not be here now that the prices are moving. They are the custodians of big capital. They're the ones that provide the capital to the hyperscalers or tell them that they're allowed to go and spend their money because they're the biggest shareholders of the hyperscalers. They're kind of voting a little bit on their views on how much capex is being spent on AI, but those guys are really coming back to the table. Now, is it going to happen overnight? I don't think so. Am I hopeful that it occurs in the next 3 to 5 years, yes, because it's absolutely fundamental in my view, but I think it'll start to occur as the prices move and as everyone starts to wise up that one can't live without the other.
And Hayden, could I ask you a question? Are you seeing any interest from the supply side to invest in the copper producers or the core mineral producers?
Fleeting interest. So there was a big push 2 years ago from the OEMs around the critical minerals for battery development around lithium, and we saw a couple of the OEM car manufacturers investing in copper projects. Question mark over what the real strategy for those investments were. But no, nothing really concrete, and that's because it is such a foreign industry. It is a very complex industry, fraught with danger and risk, and very capital intensive. And so, you know, we saw an announcement, I think, from Alphabet maybe 2 years ago, and it was a white paper talking about copper being the biggest threat to their delivery of these data center rollouts. And yet their strategy there was to go and invest in an AI exploration company called Cobalt. That's not going to bring production online in any short period of time. That's going to set you on the path of hopefully making some significant new discoveries. But,
so it's there on the kind of risk opportunity horizon, right? I mean, you look at a company like, we had to bring him in at some time, I suppose, Elon Musk and Tesla. I mean, effectively underneath the hood, a sort of battery company at its heart. You can imagine at the very senior strategic levels of an Apple or a Google saying, well, look, if we look at all of our risks all the way downstream, is there an element that we have to have an investment to stake in an organization that produces, you know, at that kind of level. You know, you saw the US government under Trump invest in Intel. When you have effectively, you know, these things are critical national infrastructure, digital national infrastructure, and you've got to be able to track that all the way down the line. So I wouldn't be surprised personally if we saw some sort of coming together of those two worlds of the mining sector and the high-tech sector.
I think that you're absolutely right. I think there has to be. I think the challenge with the battery investments is critical minerals. You know, nickel, as an example, was considered a critical mineral for battery development, but the battery technology was moving so quickly that as the price of nickel went up, they were substituting it with something else and creating a new, more efficient delivery model. Going back to Max's point, copper is not currently substitutable. Really, you can't substitute copper. Silver will work. Silver's highly conductive, but an incredibly expensive version of copper. Aluminium will work to a certain point, but then, you know, you run into what we're having in global aluminium manufacturing right now with, you know, power costs going up. It's making it uneconomic. And so at what point does that tip back to making aluminium favourable compared to copper? It's not really substitutable, and so at some point it's going to come to bite. I don't think it has yet. I don't think the realization has hit that actually this is something. It's a bit like water in the mining industry. You know, you go, well, it's okay because we'll just use whatever water's available. But when you're taking water from a population, it's completely unsustainable, and suddenly something that costs so little relative to the scale of the project becomes the thing that kills you.
Yeah, absolutely.
I think that how the different parts come together will be quite sensitive in terms of funding for it for governments. And as you say, Martin, these big groups having some sort of insulation with their investments in the upstream. When you look at groups like, people always throw around these numbers about, well, the market cap of Apple, they could buy the mining industry in a day, and you go, and secure their supply. And you go, yeah, they could. Well, why don't they do it? And I think it comes back to your point earlier, Hayden, about unlike data centers where you can, to a degree, and definitely tech, build them where you want. Raw materials are where raw materials are. And the mining sector has been doing this for centuries. And although it has a patchy record in places, it is the most experienced industry at dealing with very, very delicate, sensitive and nuanced ESG stakeholder engagement challenges. And I don't think big tech has that ability. So understanding how those pieces come together and leaving the control. I think Gary Nagel, the Glencore CEO, came out recently saying we have to, as an industry, the mining sector can't let this conversation run too far into politics and technology, because the expertise required to deliver what is required sits in the mining space. I think that's a crucial thing. And actually the point I was going to ask you about, Hayden, around the exploration, and you say, well, that doesn't really help, but you can buy all the producers you want. But at the end of the day, because of the lead time, you are going to need that exploration story. And there was already, in my view, a structural difficulty with how the industry funds exploration plays. What does that look like, and what kind of investment do we need to see to, if we manage to somehow plug this gap with copper supply, the next generation?
There needs to be a lot of changes to the industry in terms of investment in exploration, because it's a very high risk game. You know, you typically don't get a huge return for a lot of your exploration dollars, and then suddenly you'll make a significant discovery which pays back all of those previous dollars that you spent. But it is very challenging. I think we're seeing a bit of a shift from the majors in terms of their desire not to bring exploration in-house, which is what they historically did in the 70s, 80s and early 90s, but seeding smaller companies that are more nimble and able to spend the money more efficiently, if you will, without the sort of infrastructure required from these major mining companies that have much, much more onerous ESG and OH&S restrictions in terms of how they operate. You know, junior miners are very good at getting maximum value out of their dollars that they spend. And so we're seeing a bit of a shift. I think it's also got to come from the capital markets, which we are starting to see. And that's what always happens with the cycle through the mining industry, is as commodity prices go up, you'll see a proliferation of junior companies exploring for those metals. It doesn't guarantee success. What we know is it is getting a lot harder to find very high class copper deposits, but not just copper deposits. I mean, just about all critical minerals are becoming more and more difficult to discover just through the depth and the declining grades and things. So, but the shift is starting to slowly occur, and I think we'll see that continue as the copper price maintains a certain level.
It's a really interesting comparison though, because the tech companies have got an enormous appetite. In the old days, they used to say, stick to your knitting. You know, you focus on something, you do it really well. That is completely gone. If you look at the activities of the big tech companies, they're trying to spend these vast cash deposits that they're sitting on. These are multi-trillion-dollar concerns. It wouldn't surprise me at all. I'm talking myself around here. I don't have shares in any of these companies, by the way. But, it would make a lot of sense for them to at least have some kind of persuasive power, let's say, on all the core components all the way down the line. If you look at the way a Microsoft or an Alphabet, Elon Musk's group of companies behave at the moment, they are not sticking to the knitting. They're really trying to grow and widen out and take an interest in everything that affects them. So I think it's going to be very interesting times. And they can't. The challenge they have, I think, in the data center side in particular, is they can't live with the kind of lead times you're talking about, where you're talking about multiple years. These are companies placing their bets, and most of those bets are going to fail, right? They're going to start up companies, they're going to start up projects, going to squander tens of millions, hundreds of millions, sometimes even billions of dollars on this might work kind of blue sky thinking investments. So they're not afraid of that kind of build out or that kind of risk, because they've got money to burn, almost literally. So it's a very interesting idea that, we started out talking about how very different these two technologies are, these two different worlds are rather. But I'm starting to see much more collusion potentially in the future.
I think one of the key changes has been historically software companies or internet-based companies. Once you develop the product, the return on investor capital is effectively infinite. Yeah. So it makes it a very, very high margin business. But they're now transitioning into what is much more like a mining business, where you've got huge upfront capital to get set up, and then you're trying to eke out a return on investor capital over the fullness of time. It's a bit of an arms race at the moment, but maybe they're not too far away from realising that they need to take a view that exposure, at least equity exposure, to some of these critical minerals will be fundamental. I mean, we've seen it historically with the Japanese and Chinese steel companies taking stakes in both metallurgical coal and iron ore companies for exactly that reason, to remove some of the volatility in the underlying commodity price. It still doesn't protect them from the bottleneck of, they need this critical material to actually win the race of building out their data centers. And then, we're going back to the point about when I was in China last year, I was blown away by the amount of investment in not just in data centers and AI, but in the electricity grid in general. They're so far ahead of the rest of the world. And so are these economies going to start to wake up? And, potentially that's some of the reason for what the US is doing now, which is stockpiling what they deem to be critical.
Oh, and what does it feel like at your end? I mean, is your sector, the supply side, kind of aware of these guys with these lovely trillions of dollars in their pockets, and you're something they really need? Is there that awareness on your side, or?
I think from the inside of our industry, we look out and go, well, these guys definitely need us, and we go and have meetings, and we've done the meetings. But when you get into the meetings, it becomes very clear very quickly that there is a fundamental lack of understanding of just how complicated the mining industry is and just how long it will take to bring this supply on.
Can they buy that understanding?
They can, but they haven't started doing that yet.
I just wanted to illustrate something. So, is the data center industry at least theoretically capable of producing so much demand that it inconveniences everybody else and drives prices up? And the answer is yes, because the RAM price crisis started last year, and essentially RAM prices have doubled because data centers for AI has been buying out all the memory capacity. And so prices are doubling, prices are probably going to triple, prices are doubling on some storage products, like flash storage, hard drive storage. So the industry is its own worst enemy. It cannot grow responsibly. At the moment, everybody's out for themselves, and it's happening, like on gensets, lead times are lengthening, on turbines, lead times are lengthening, on medium voltage transformers, you're in trouble. So the data center industry is capable of disrupting a market to the point where it becomes uncomfortable for everybody else, or at least driving the prices up. So, it bodes well for copper pricing.
Yeah. Well, it's actually an irony in that we're about to go into the stage of building our project in 2027, starting the build out of our project. So we're one of a handful of new copper projects that's actually permitted and ready to go into construction. And on our list of long lead items that are fundamental that we have to put deposits on now, transformers. Why? Because the copper involved in building out those and the demand from data centers, which is ironically the reason we're investing in a copper mine, is going to be one of our key focuses.
Yeah.
Max, you talk about we're all talking about price hikes and what that means. Obviously, the higher the price, the greater the incentive to go and find more copper. If that price really flies, is there a possibility that copper gets to such a level that it becomes an issue for data center builds? Or when it comes to a data center build, are there much larger components that control the overall capex, and copper, you essentially can pay what you need to pay for it? I'm thinking about the nuclear industry, essentially, where the price of uranium can absolutely fly, because at the end of the day, if the utilities need it, they just go and buy it, and it's actually a small part of their price mix.
I think copper is the same, and because we mostly consume the industry mostly consumes copper in its pure form. We just need the metal. We don't even particularly do anything with it. We just put it in bus bars and into cold plates. So I think data centers, no matter what happens, they will pay. They will they will shrink their own margins, because margins for colocation operators, hyperscalers, neo clouds, these are very, very fat margins. So if they need to erode their margins to make sure that they can continue delivering the services, I think they will do that. It is there's a lot of money splashing in the industry, and I think you're right. Even if the price doubles, they will pay, because in the grand scheme of things, as Martin said, it's probably it's going to go from 0.5% of your overall capital expenditure to 1%. That's a rounding error, considering that your AI chips, prices are insane and margins are very, very interesting. It's just
And what about the skepticism that I've been hearing at the scale of the investment that's going ahead in the AI build out, but the skepticism amongst investors and the feedback that they're giving the Magnificent Seven about it, to say, well, what's the business case? What's the use case for this AI build out? Are you just charging ahead without any clear use case? But then you look back in history at something like Facebook, that everyone, there was no clear business case. It was make it popular and then we'll turn it into a business. What's the sort of view on that from the inside?
I think you're right. We have just seen a season of financial results where hyperscalers were essentially punished for the capex, right? And I think there is likely to be a readjustment. Like it is highly likely that we're way too enthusiastic about AI, and there's going to be a period of consolidation. But demand for data centers it might weaken for a little bit, but it's never going to reverse. So like everything that's being built today will find a use for it, and we will need more. And I think there will be consolidation. I think some of the neo clouds, like there's 200 neo clouds, and they're all essentially selling commodity service because they're just access to GPUs. So I think many of those are gonna probably disappear. But the hyperscalers, the Metas, the Googles, the AWSs, they're going to come out of this swimmingly, even if there's a general downturn, and even if there's a readjustment in terms of like AI stocks, investments. Like if investor confidence goes, Microsoft is still going to Microsoft.
So it sounds like they're going to stay the course. Sorry, Mark.
I just think it's for the data center folks and for these technology oligopolies and plutocrats. It's heads they win, tails they don't lose. Anytime if the world goes into a tailspin and everyone's trying to save money, they're going to use more data centers for compute. They take out stuff that they manage in-house and they put it to a third party, and they pay for it on the never, right? If the world goes into hyper growth and everyone wants to invest in innovation, new projects, of course they win, because that's the best way to try things out. This is just the new playing field. It's the table stakes. And these multi-trillion-dollar concerns are holding all the cards. Who could believe a company like an NVIDIA could become the world's largest company by market cap? It's just phenomenal, and they're just a component brand, right? Yeah. So we talked about copper and these big data centers and these enormous tech companies, and I think we've done a good job joining the dots here. I've persuaded myself, or you guys have persuaded me over the course of the conversation on what a strong symbiotic connection there is between the two worlds.
It doesn't sound like it's going to be a price-sensitive issue. It sounds like it's absolutely a supply issue. And at the risk of being slightly crystal ball gazing, if we aren't able to deliver, I say we, if the mining industry isn't able to deliver those raw materials, what is the fallout if the data centers aren't built? And Martin, maybe your view from a broader tech perspective on the importance of data centers with what is now a digital economy. What does it look like if we don't have the data centers or don't have them in time?
Well, we've kind of had issues in the past, getting planning permissions, regulations, access to power. Here in London, where we're recording this, when we had the Olympics, there was a bit of a set to try and get access to power because of all of the infrastructure projects that were occurring. So these companies are pretty tried and tested now. They know their ways around getting access. It just makes me think that they're going to want to have stronger control over the core components. And if we agree that copper is one of them, they're going to want to de-risk all the way down the line. And, maybe some of those actions will be surprising. Who's to say that an Apple or an Alphabet wouldn't invest at a strategic level in some of that kind of component level fabric? Without it, what are the risks? Enormous, because every time we do pretty much anything in this digital world now, then we're touching on the capacities of data centers and connectivity. What's the most affordable conductive material in the world? I think we've mentioned it once or twice today. It's copper, isn't it? How do you build out these data centers? Copper is a big component. How do you cool them? In the old days, used to say cooling was about 1-to-1, I think, max, with the compute capability. Costs you 50 to create the compute, 50 to cool it, because the thermal characteristics are horrible. What's a great answer to that? Copper again. You can see that the two are so close together, and I don't honestly, Chris, see a situation where build-outs will fail. I can see a situation, as Max mentioned, where the data center folks and the technology companies want to have more than their fair share of access, and that might create some interesting market dynamics.
Hayden, what does the price need to look like to provide that incentive in your view? Obviously, at the risk of talking your own book here, but I'll trust you to be honest with us. What do you think the price needs to look like to, one, incentivize the CapEx financings for projects that are looking to get into development, and then to flow downstream to start encouraging people to be more systematically well funded for exploration?
Well, we're at $6 a pound now, which is, brushing on all-time highs in a nominal sense. In a real sense, it's still well off all-time highs. So I think we need to see it sustained, certainly above 5, probably even above 5.50, and sustained. As in, it needs to go higher, but we need to know that the floor price is probably well above 5 to start to encourage CEOs who own these big projects to say, all right, I'm going to take my company's money and I'm going to invest, because the return that I will get from that is better than returning it to the underlying shareholders. Bear in mind that all of these shareholders who are invested in the mining industry are driven by quarterly returns and are answerable to their masters. And when they see capital being spent on things that are suboptimal from a return on investment perspective, they start to jump up and down and tell them that they want their money back. The only way to encourage money to be spent is for the price to go up to that sort of level. But then we'll also have the cost creep that occurs. And so then the price needs to climb again. So I'm saying if it stays above 5, then I think we'll start to see some incentivization. The one thing that may change completely is if we have some of these very sort of not sensitive to returns, but very sensitive to security of supply investors coming into the market and saying to, BHP or a Rio or an Anglo-American or Glencore or First Quantum, we will underwrite a significant proportion of your project build at a very low cost of capital, which will allow you to juice up your equity returns to your investors and justify the purpose of taking the risk. I haven't seen that occurring yet. It's not to say that it can't happen and can't happen reasonably quickly. I think what we know about humans is as soon as a problem presents itself, we're pretty good at solving those problems when we're forced into it. At the moment, it doesn't feel like we've been forced into it.
Max, we spoke previously or earlier about what data centres will look like in 2026. And Martin, you picked up on the point that there are actually more parallels between the tech or the data centre space and the mining industry than you'd realise. And one of the really interesting things Max brought up was the objections. And not just bottlenecks as we might think there could be on supply chains, etc., but actual social objections to data centres becoming a real issue.
So maybe back 10 years ago, like everybody loved data centers. Governments, national governments love data centers. Local government love data centers. People were giving them tax breaks. People were trying to attract them. Come, Microsoft, please build a data center in our little hamlet. And it's gone 180. So what we see in 2026, I think, is going to be a year of popular resistance against data centers. Data centers have now obtained it's a bad reputation. They're blamed for consuming too much water, too much electricity, much like some of the other industries. They're blamed for their noise. They're polluting. They're not creating enough jobs. And why are we giving them the tax breaks in the first place? People are scratching their heads. They don't understand why that is happening. And in many for example, in Northern Virginia, there is now talk, I think, about stopping tax breaks, and it's that's going to be a very, very big change. We need to recover relations with local residents, and we don't have a playbook for that. So we might need to borrow the mining playbook, because honest to God, I think 2026 is going to set a record for data centers cancelled over local opposition. We already this year, Uptime has found four projects that have been cancelled, 4 at high risk of cancellation, and it is actually happening because when you're a local politician and you're making a zoning decision or a planning decision or a land acquisition decision, what you actually care is you need those 300 people who are protesting against a data center on site during the next election. Otherwise, you don't have a job. And that job is more important than multiple billion data center project. Absolutely. And we see them being cancelled. So I don't think just providing information, just providing data, just talking about like how data center industry is actually useful, and all of you are using Facebook to coordinate your protest against data centers. I think that's not going to work. We will need a different playbook, and honestly, I would be very interested to hear how you guys are dealing with it, because like mining, data centers are essential. You know, like everybody needs it. Everybody needs copper, aluminum, cobalt, lithium. How do you navigate community relations?
It has been a never-ending battle, and in fact, in the period of 15 years that I've been working in the mining industry, when I first started, it was very much a dirty word. Nobody really, they were like, "Ooh, you're in mining, that's terrible." But like data centres, mining is ubiquitous in our day-to-day living. In fact, there's nothing, you know, the Robert Friedland, who's probably one of the greatest mining entrepreneurs, goes online to say everything that we use on a day-to-day basis, basically everything we touch, except for free thought, is somehow touched by the mining industry. And so people who, you know, I laughed at your analogy about people protesting on Facebook, driven by a data center that they're protesting against. You know, I turned up at a conference once, and the Extinction Rebellion were there. Fine, you know, I celebrate their right to hold the mining industry to account, but they were banging metal pots and pans at me and filming me on iPhones, having caught the train, which was powered by electricity, into the conference centre. The hypocrisy and the irony of it was not lost on me. I don't diminish the need for mining to be held to account and make sure that the industry is sustainable and developed responsibly. And similarly, people want their data centres, and the benefits that it's driven in the global economy can't be discounted. Everyone has a right to hold everyone to account, but there's got to be some rationalism and realism and pragmatism applied by people. Unfortunately, the industry, what the mining industry has learnt is you need to spend a lot of time and money marketing why you're so important to people's lives. I think one of the big changes that's occurred in mining, and maybe this is something the data center industry needs to do, is we've rebranded ourselves as critical minerals. So you'll never hear me talk about mining. I'm now working critical minerals, critical to humanity.
I think the other thing that is probably worth actually mentioning on Max's point is that the stakeholder engagement process in mining is actually now very sophisticated. And when you think about it from a natural infrastructure build, there's a town hall meeting, and then someone says, yeah, you can build that if you know the right people, then up it goes. Whereas in mining, because it's had to be the case, and we probably take it for granted, the process of engaging people at what point, with what information, has become quite sophisticated. And obviously, Marimaca, from your perspective, you permitted at record times. It's probably worth just giving a little bit of background on what that process looked like when you decided to start engaging, what kind of information you shared, and how you got that to move forward so efficiently.
So the social engagement is never ending, and the engagement with our local stakeholders is never ending. And the objective of it's slightly different in the sense, I understand that AI data centres don't need to be so close to population centres, but data centres that drive our day-to-day interaction need to be close to population centres for latency issues. So, you know, the way that we've approached it as a mining industry now is, okay, well, we're developing this asset responsibly. Hopefully it's not next door to a town, but if it is, what can we do to mitigate the risks to those towns, and what can we do to ensure that the project is developed for the benefit of all of the stakeholders, not just our shareholders, not just the government, but very focused on the local stakeholders. And then I think slightly different to data centres is there are a lot of downstream risks for mining. So you dig a big hole in the ground, and you process these minerals, and then you have waste byproducts. There are significant knock-on impacts downstream, and that's where the big complication occurs in mining. It's not the digging, it's not the processing, it's what happens if something goes wrong down, and how do you mitigate those risks? And that's been a heightened focus. And so early engagement and consistent engagement and openness and willingness to hear the concerns and try to adjust the project and not just try and jam a square peg in a round hole for economic purposes is fundamental.
I think that's been the big difference since I started in the industry, and I imagine you've probably seen a similar thing, Hayden, where I think that probably was the attitude maybe 20 years ago, that people would say, this is something that we have to deal with, it's a box we have to tick. And the big change has been, recognising the problem and then addressing it with sincerity?
Well, our permitting strategy, which was basically unheard of, and we got a lot of pushback from our advisors in country, was rather than do our definitive feasibility study, which is the final document that really says this is what we're going to build, and then try to drive a permit decision through on the definitive feasibility study, we took a view that we should review the legislation and the regulations, and then we should design our project to adhere to the risk mitigations that we would need, what we need to protect, how we need to protect our stakeholders, and then finish our definitive feasibility study based on what we thought would be permitted in the most responsible way. And that was well received. And unfortunately, well, or fortunately, that's probably going to be the new paradigm for mining, which is environmental and social considerations are driving rather than engineering driving the final decisions. But the challenge there is the cost of extracting those minerals when you do it in a maybe not an engineeringly perfect way, a perfectly optimized perspective from an engineering, the costs of producing the underlying material will go up.
It's really interesting to hear. I mean, Bill Gates famously said that if he was down to his last $500, he would have spent on public relations. I never ever got that impression of someone who was, high up at Rio Tinto or whatever back in the day, suggesting something similar. But it's very interesting. My feeling is, we talked earlier about the potential for there being a decline in the market and what would happen then. Well, I think, we're all very aware in the tech sector of the potential for what they call an AI winter, where everyone starts to sell shares and say, actually, no, that was a stupid idea. But, they can ride it out, these tech companies now and the data center companies. It happened with .com, and when it bounced back so massively. They can ride out any potential risks, downturns, slowness in the economy. It's so much at stake with AI in particular and the other tech waves that I think they're going to be absolutely fine.
What happens with longevity, Max, of a data center? We're talking about raw material supply and delivering for data centers over the next 5 years, as if these things are going to be around forever. How long do they last for? At what point are you starting to try and rip out components and recycle or get new raw materials to feed new data centers?
So the building is usually designed for at least 20 years. Again, it only works if there haven't been like major changes in design over 20 years, which is highly unlikely, really. But the innards, you probably, sometimes something like your power distribution equipment, you change probably every 10 years. Something like your cooling equipment, 10 to 15 years. So everybody has a different life cycle. Obviously, IT equipment, it only lives there for 4, 5, 6 years. And then you check it out, cold plates included, right? So managing these life cycles is a very, very important part of the job. And the demand for materials is never ending. Like every time you wheel in a new piece of equipment, you're essentially you're taking something out of the environment. Because again, I think conversations about recycling are going to become much more important because, again, supply is not unlimited of these materials, and it's just like, and there is value, especially like in something like copper. It's very, very easily recyclable. So these things need to be better. But also, in terms of life cycles, I just wanted to say about, Martin highlighted speed to market, and I think this is where the great disconnect is. We've learned to build data centers very, very quickly. If you've got planning permissions, it's generally under 3 years. Everything else takes longer to build. A mine takes longer to build. A power generation project takes longer to build. Like power transmission lines take longer to build. So this is the trouble that data center operators find themselves in. That they are happy to build at breakneck speed, but it's the supporting infrastructure, it's the companies, it's the equipment that are not quite there. I mean, we talked about lead times for equipment lengthening, right? They just like eventually, the system is rebalancing itself, but it is a confusing time because the system is rebalancing itself.
So I'm just wary of admiring the problem. I think we've established that we have a little bit of an issue that is confronting us at the moment, joining those dots and connecting the upstream and the downstream. I wanted to spend just a moment before we do wrap up on some of the solutions, which we have touched on. But Max, maybe if I can start with you, just from a data center perspective, downstream perspective, what do you think needs to happen to make sure that we do have the data centres that will be required for a digital economy and for life going forward?
I think, there's no danger that we're not going to have enough capacity. We're building so much capacity, we're probably overbuilding, but again, none of it will ever go to waste because like our hunger for data centers are again insatiable, and it just like the most will, even if there's a market downturn, okay, some of the data centers are going to stand empty for a couple of years, and then, you know, like we're going to reach a point where we actually need that capacity again. But I think the process of building large dense data centers is so complex and so capital intensive. None of the data center people will ever get to thinking about copper. Somebody else needs to solve this issue. They're basically, they're trying to track 1,000 different things, and none of them are the price of copper. So like from this point of view, basically, send them a bill and they will pay it, and they will move on to the next thing. So it's a very, very interesting time right now, but we're just like, speed to market is very, very important, and essentially people are throwing money at each other just to move quicker. So it's an interesting time, and again, if we overbuild it, it's not going to go to waste. But I think, yeah, thank you for telling us about the price of copper, but basically I think I'm going to leave this room and I'm going to try to forget it.
Hayden, will money fix this problem from a supply perspective?
Absolutely. A lower cost of capital and a higher copper price will drive future construction decisions and development decisions from the miners. And, you know, I say regularly, there are more than enough projects in the pipeline for the short to medium term to satisfy this build out, this boom. Maybe in the longer term we have to start getting creative, but I think nothing solves a supply crisis like price. But it was an interesting analogy about, you know, the send me the bill, you know, that's music to our ears in the mining industry, but it's an interesting analogy to think of the data center boom and the AI boom as kind of like a gold rush. And actually the mining industry for the first time in its existence is not looking at trying to be the commodity driving the boom. We're selling picks and shovels to the data industry, and we can basically sell it for whatever price we want. That has always been the issue around mining. It's always said you make the money not by mining, by selling the picks and shovels. So hopefully we're going to become a pick and shovel industry rather than a commodity industry.
Martin, solutions?
That's a great metaphor, by the way. You know, if you go back to the dot-com times, some of the companies that did best were the picks and shovels providers. That was data centers, server makers, connectivity folks, et cetera, et cetera. And I don't see why it would be any different this time. It's amazing, though. We're all experts now, aren't we? I remember 25 years ago, 30 years ago, where data center companies were thinking about getting rid of the facilities, selling them off for retail or gymnasium, sports clubs, whatever. Now I don't see any going back. And you know, my modest proposal, listening to experts today, is that maybe it'll get verticalized, and we might see tech companies becoming, let's say, at least more interested in the supply side all the way down to the mineral component.
Martin, Hayden, Max, thanks very much for your time.
Thank you.
Thanks very much for joining us.
All right, good stuff.
That was great.
That was amazing.
Really, I feel like I've learned a huge amount. I'm more scared than I've ever been. More excited than I've ever been.